What's up everyone, it's Caddy with MoneyVest. So I've got another very nice educational video for all of you. So today we are going to be talking about the 5 most dangerous cognitive biases when it comes to investing. And these are cognitive biases that I've experienced myself, and we're all human. And when it comes to investing and trading, there's going to be a lot of emotions at play. So I'm sure that these are, cognitive biases that you have most likely experienced in your investing and trading journey as well. And I have as well, and I'm trying to minimize them as much as possible. I'm going to also share lessons on how to avoid this from happening in the future. So these are lessons that I've learned from several books and just been reading finance, investing, business books, and just kind of getting a good understanding on how our emotions and our cognitive biases kind of play a role when it comes to investing. Because at the end of the day, investing and trading has a pretty significant emotional aspect to it. And, very successful investors and traders are very intelligent emotionally, right? It's not so much about the analytical ability, because you can pick up analytical ability over time. You can learn about fundamental technical analysis, but it's the emotional intelligence that only comes with experience, with the time. You can't really learn that in a few crash courses or a few weeks, right? It only comes after years of practice and being in the markets, going through the ups and downs and learning about yourself. That's what you're really doing, right? With fundamental technical analysis, you're learning about the company, you're learning about the stock, you're learning about the management. With emotional intelligence, you're really learning about yourself and how you handle different market circumstances. So hope you guys enjoy this video. And again, we're going to continue our series of these educational type videos where I break down specific chapters and books and whatnot. More detailed book reviews are going to be covered in our main MoneyVest Reads channel, and a new video is going to be uploaded very soon. So again, hope you all enjoy it, find it helpful. Make sure that you drop a like and of course subscribe to the channel, and comment down below if any of these 5 relate to you, right? If there's 5 out of 5, or if there's 3 out of those 5, or at least 1 out of those 5, let us know in the comments, because like I said, we're all human. I've probably suffered through all of these cognitive biases, so I have no shame. I'm not embarrassed to kind of admit that yes, I have gone through the process of running into these cognitive biases and these pitfalls and mistakes. So let us know in the comments if you've kind of dealt with any of these. So the first one is, before we even get there, what's the goal, right? As an investor and as a trader, our goal is to be as rational as possible and to be as objective as possible. And those are 2 really important keywords: rationality and objectivity. Rationality basically means to do the rational thing, right? What makes sense is what we need to do, right? And objectivity is basically looking at any particular project or stock or investment, whatever it is, and giving your objective analysis and not being subjective, right? Subjective meaning not having your sort of emotions or your opinions be dictated by your emotions. Objective is looking at the face value of that investment and being as unbiased as possible. So that's what objective analysis is. And that's really what the whole idea is when it comes to investing in the stock market, trading, whatever it is that you're doing. You want to be as objective as possible with rational, clear thinking. But of course, cognitive bias, emotions come into play. And the first couple ones are, kind of go hand in hand. The first one is confirmation bias. And confirmation bias is really when we have predetermined belief about a stock or an investment, and we look for information that's going to validate our pre-existing notion, pre-existing belief, right? So to give you a simple example, let's say that I am bullish on Tesla long-term. Let's say that I believe that Tesla long-term is going to be a very strong company. It's going to continue to grow. I'm a huge believer in Tesla. A confirmation bias would come in if I constantly look for information and pieces of data which validate that thesis that yes, Tesla is going to be a very strong company long-term, and completely ignore the other side of the story, which is to completely ignore if there's anything bad going on with the company, if there's any negative catalyst. I completely ignore. I turn a blind eye to those types of catalysts because I'm in that cognitive bias, meaning I've got confirmation bias for that company. And again, this is just a simple example that I'm giving you, right? And I've certainly faced that. I admit I've gone through that process. And confirmation bias, once again, is just kind of validating your pre-existing beliefs and your notions about a certain company or investment or a stock. Now, the way to avoid that, obviously, is to actively seek out opposing views, right? So actively ask people around you, ask other investors, ask other people who may not agree with your thesis, who may not agree with your analysis, right? So ask and seek out actively opposing views. Always be skeptical. So ABS, always be skeptical with whatever you're doing in the markets, because nothing is perfect, right? No company is immune. No company is perfect. No management is going to be perfect. So always be skeptical. And yes, we can have a very good formed thesis on a company, whether it's bullish or bearish. Regardless, always be skeptical, about that. So critical objective evaluation is also very important. So we have to be very critical. And at the end of the day, we have to be honest with ourselves with any type of analysis that we're doing, whether it's on, a particular stock or a crypto or real estate or whatever it is that we're investing in. At the end of the day, it all comes down to being critical, being honest with yourself, and having an objective evaluation, unbiased evaluation, then making sense whether to invest or not. The second type of bias, which is again a dangerous bias, is anchoring bias. And anchoring bias kind of goes hand in hand with confirmation bias, but anchoring bias is basically going over the idea that all of our analysis and our thesis is dependent or anchored towards one or maybe two data points, right? Only a couple pieces of information is what makes our thesis. So that again can be very dangerous, because if you don't have all the information, all the pieces of the puzzle, well, guess what? We can open ourselves to insane amount of risk. So anchoring bias, avoid it at all cost. And the way to do that is, of course, once again, be open-minded and listen to other perspectives, and also account for other pieces of information. And again, I've done that before, where I've anchored myself to a particular stock, just looking at one data point or one specific trend or one specific information, and just kind of basing my entire thesis on that stock based on that one or two pieces of information. Don't do that. Obviously, look at the entire big picture and understand what the company is doing, how big is the TAM, how's the management, how's the fundamentals, how's the quantitative analysis, what's the intrinsic value, what's the valuation, kind of understanding as many things as possible about the company to better understand the risk and the reward for the future with that investment. The third one is going to be overconfidence bias, right? So if you're on a hot streak, right? If you've got a lot of trades, if you've got a lot of investments under your belt that have been super, super aggressively high, like winners, there will come a time where you start to feel like you're Superman in the market, right? You just can't lose. And that's happened with me before. And, that's a little bit of an overconfidence bias, which basically means that, obviously you're very overconfident in your ability to trade or invest or pick stocks. Markets are a very, very markets have a very good way of bringing people back down to earth. And that is to say that markets can really hurt investors if they start to feel overconfident, right? And that's the worst type of pain, is obviously losing money, right? One of the worst type of pains. So overconfidence bias, always take a step back and ask yourself, am I overconfident here? Am I starting to be, again, excuse my language here, but am I starting to be a little bit cocky, right? Am I starting to be overconfident in my ability to trade or invest in the markets? Very, very important stuff, because that happens all the time, and the markets can humble you in that way. So the way to avoid that, obviously, is focus on risk management. The risk management is very, very important, something that we have talked about a lot of times and previously on our channel and our previous videos as well. And that is to say that every single stock, every single investment, there's no free lunches out there. And every company, every stock, every investment has risk, right? The risk may not be observable. You can't quantify or calculate that risk, but it's there. And just because the negative outcome doesn't happen, just because the risk is not realized, doesn't mean that it's not there. It's always there. It's always present. It's our ability to analyze it well. And as Howard Marks talks about, being able to recognize risk, control risk, and manage risk is very, very important. Focus on base hits over home runs. And that's another thing that, we've talked about on previous videos, where once you start to get a little bit overconfident, you start to size up, you start to take bigger and bigger positions, you start to kind of leverage up a little bit. And before you know it, that luck starts to run out, or maybe your ability is not as good as what you thought it was. And then, of course, you end up in a very bad situation. So focus on the consistency of base hits. Build a process which you can trust on over time. And then, of course, you can size up with proper risk management over time, but just make sure that you have proper risk management and you're focusing on the base hits as opposed to hitting it big in 1 or 2 trades. The fourth one, which I have dealt with to this day and I'm still dealing with right now, I don't think I've got overconfidence bias. I don't think I've got anchoring bias. I do look at a pretty holistic overview of the entire market and the stocks that we're analyzing. Maybe a little bit of confirmation bias in some of the stocks, I would say. So that's something that I'm still dealing with. And loss aversion bias is definitely still there. And that is basically the idea that investors invest very, very defensively. And I consider myself to be in that sort of category where I'm not one for taking on too much risk, right? So I'm not one for, and again, you've been watching this channel for quite some time. You know better than me that I am a very risk-averse investor, that I'm a very conservative investor, and I don't like to take on too much risk. You'll never see me put in 40, 50% in a stock without any analysis or invest in speculative companies that are not profitable, that are generating negative cash flow. But the thing is that oftentimes those companies, because they are, starting to turn the corner, they are the ones that are speculative, ends up, being up like 100, 200, 300%. And that's the cost of investing defensively, is that you have to give up some of those speculative companies in order to stick to your process. And I don't know how I sort of feel about this cognitive bias, but yes, there is a loss aversion bias where that basically is a cognitive bias that sort of forces investors to not take on too much risk because they want to avoid losses. And the way to avoid this, and something that I'm working on, is practice loss acceptance. And that is to say that, when you're investing in the markets, losses will be a part of the game, right? Losses will be a part of your investing journey. Like, you can't there's no investor in the world that's never experienced a loss in the market, right? Every one of us has gone through it. Every single person in the markets, when they've been investing for a very long time, has experienced losses at some point in their investing career. So we have to kind of be accepting of the fact that losses are just part of the game. Our job, obviously, as part of risk management, is to minimize those losses the best we can and stay disciplined. And again, like I said, I don't know how I feel about this bias. I'm happy with this bias to some extent because that forces me to kind of invest a little bit more in a disciplined way. But at the same time, the opportunity cost for this is giving up on the potential for investing in some speculative companies that may end up being huge winners. But that's something that I guess you have to be accepting of, that you're not going to catch all the winners. As long as you're trusting your process, you're disciplined with your process, you're going to catch, some winners and give up on maybe some of them. So yeah, that's where we are with loss aversion. And then finally, we got the recency bias. And this is something that I feel like I have been talking about for quite some time on the channel. And I can probably say that I've got this under control to some extent. And that is to say that markets move in cycles. And every time markets, sell off or they push higher, we have to just be understanding of the fact that it's not going to go on forever. And it's true for individual stocks as well, right? Because this is, it kicks in as soon as a stock or a index is on a hot streak, right? If you've got a stock that's been up like 100% or 200%, it's on a winning streak, it's just been going higher. Well, guess what? Recency bias tends to tell you that it's just going to keep going higher. You buy it here, it's going to keep going higher, you're going to make a profit, and you're going to be able to sell it at a higher price. And that's what recency bias does. It takes the most recent events and tries to extrapolate the future, which is never the case, right? I mean, recency bias, something that we need to avoid at all costs, and understand that if the markets are going higher or lower, it's not going to go on forever. At some point, we are going to reverse because markets move in cycles. Stocks also move in cycles. So the way to avoid that, obviously, is to understand market cycles and be strict with valuations, right? Don't go crazy, and no investment is worth investing in regardless of the price. We always have to look at the price. That's the starting point, price and the value, and understanding, okay, is the price really worth the value that I'm getting? If not, the answer is no. Then you're better off looking at other opportunities or waiting patiently for the prices to come to us. But recency bias definitely plays a significant role, especially when it comes to momentum traders in general, because we're kind of putting a lot of weight on the recent events as opposed to the overall value of the trade or the company or the business that we're investing in. So those right there are the 5 most dangerous cognitive bias that I wanted to go over. Let me know your thoughts down in the comment section below. And the most important thing is recognizing that you have some of them and kind of understanding that, okay, what are your weak spots? because the reason I'm doing all these educational videos to kind of help us with our psychology is because, like I said, psychology plays a big role in our investing, right? I mean, you and I can have the same analytical ability. We can analyze a stock in the same way, but we're both going to react very differently when the market's going higher, lower, when the stock is going higher, lower, because of our difference in emotional intelligence. That's why it is so important to learn about yourself and be honest with yourself what your weak spots are. I've got weak spots. I've got blind spots here in investing, and I'm totally fine with accepting of that and need to work on that, right? That's what makes us better and better investors each day. So your competition isn't with the next person, it's just with you, and you have to keep getting better at it. And again, emotional intelligence is something that you work on over years of practice and experience and learning about yourself. So hopefully this video was helpful. Again, a little bit of a different video. Again, we talk about these books for a reason. This is another book that I'm reading right now, The Laws of Wealth. Very, very nice. I'm probably going to be done with this by the end of this week. We'll be starting a new book. And I'll again share that in the Discord, which book I'm starting with next week. So hope you all enjoyed this, found it helpful. Make sure that you drop a like, subscribe to the channel. Happy investing. I'll see you all in the next video.